call the meeting to order. This being my first time as chairing it. I apologize in advance for any gaffes and would ask that the CEO and the vice chair please correct me. If I make any mistakes, no ill will be harbored, I promise. Welcome, everyone. First of all, we have a proposed agenda in front of us, and I'd like to call for a motion to adopt it as presented.
I move. Second.
We have a motion and a second. Any discussion? All right, then we have an agenda. Second thing is you all should have received a draft of the minutes of the meeting from our June 4th. Do I have a motion that we accept those as presented?
So moved.
Second.
We have a motion and a second. Any discussion on the minutes from the June 4th, 2020 meeting? All in favor of approving the minutes from the June 4th meeting, please do so by saying aye.
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 Any opposed? The minutes are the minutes. Next, going to committee reports. And we do have call for a motion to adopt the recommendation of the Audit and Enterprise Risk Management Committee to amend the Audit Enterprise Risk Management Committee charter as presented and authorize staff to make the technical revisions to the charter and other RSIC policy documents to reflect this decision. Can I get a motion to do so?
Mr. Chairman?
Yes.
I know that's styled as a motion, but actually because it's a report from the audit committee and a recommendation of the audit committee, it just goes to, I mean, obviously there can be discussion on it, but it just goes to a vote.
It just goes to a vote, Mike?
Yeah, because it's coming from a standing subcommittee, so it's already an active motion when it gets to
Right.
us.
Yeah,
All right,
you don't
then
need, right.
I then will call for a vote on the matter. All in favor, please say aye.
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 Any opposed? And so it is. All right. In addition to that, everyone should have a report from the June 16 meeting. I hope you've all have been through that. And are there any questions or discussion on that before we move on? Hearing none, we'll move on. Next item is a committee report from the Human Resources and Compensation Committee. I'd like to recognize Rebecca.
Thank you very much, Bill. The HRC committee recently met and reviewed changes to positions and salary changes throughout the organization as a report provided by Brittany and Mike. There were no actions coming out of the committee meeting.
All right, thank you very much, Rebecca. Next is the chair's report. Every time we turn over,
Bill,
I'm sorry.
I'm sorry. I'd mute it. Can I ask Rebecca one quick question on that?
Please go ahead, Alan.
I know a few years ago we had hired a compensation consultant. How long has it been since we sort of benchmarked or re-benchmarked or in definitions? I know that's kind of ongoing, but I didn't know are y'all still working with a consultant there, or is that something periodically that comes up, or?
Yeah, no, sure. That's a good question. And Mike, you're welcome to jump in at any time if I say this wrong, but that came up, I think it was about a year ago, that it was time from a charter standpoint to rehire, but we were still receiving benchmarking information data from the consultant. And so we used that at that time just to, again, verify where we were with all the salaries and the bands, but opted not to do another RFP to hire another compensation consultant to redo the entire HR salary and banding structure, given that we felt we had just done it 3 years previously and we still had all the benchmark data. So, and they're still actively updating that and using that when, and in fact, during the reporting, Mike indicates where each staff member that has received any sort of incentive or not incentive, but change in salary for a promotion or those types of activities, and where they fall in their tri-tile, or it's first, second, and third in terms of their banding. Does that answer your question?
It did. Thank you.
All right, anything else for Human Resources and Compensation Committee Chair Rebecca? All right, there being no more, we'll move to the chair's report. That's me. Every 2 years when we change the chair to our commission, the chair is required to submit a slate of committee members or assignments to different committees. And at this time, I'm proposing the Human Resources and Compensation Committee from this point forward be comprised of Ron Wilder, Ed Giobbe, and myself, and the Audit and Enterprise Risk Management Committee be comprised of Rebecca Heggie and Bill Condon. I think we need a vote on that, but before we can do that, I'll open it up to any discussion. No discussion. I'll call for a vote on that. All in favor, please say aye.
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 You notice I was the quickest one on that.
You want to make sure you didn't get drafted.
If there's any opposition, please signify by saying no. Very good. Now we have our slate of committee assignments going forward. Next time, we'd like to get the CEO's report. I'd like to turn it over to Michael Hitchcock.
Thank you, Mr. Chairman. Just by way of introduction, we do have 2 new staff members that I would like to introduce virtually. Normally at this point, I would embarrass them and ask them to stand up and so we can take a look at them, but unfortunately that's not an option right now, given the virtual environment. But first of all, I'd like to introduce Evan Affinito. Evan, we're excited to have him as a new member of our private equity team. Evan joins us from Eaton Corp in Cleveland, where he most recently managed all the investment related aspects of Eaton's $11 billion in assets, with a primary focus on their $3 billion in defined benefit assets. He's previously worked in the industrial and electrical groups at Eaton, and before that, he worked at a place that we know called Westinghouse Electric Company, and he graduated from a fine university, the University of South Carolina, with honors. He got his BS in finance and his minor in actuarial mathematics and statistics. He is a CFA and Kaya charter holder, and we look forward to all of the good things. And he's actually has hit the ground running, and is already working on a few deals that we have in the pipeline, and we're very excited to have him. Just a reminder that for everybody to mute their mics if they can, because we're getting some feedback. Okay, now it's gone. All right. Also, Mr. Chairman, I'd like to welcome Michael Andreasen. He joins us by way of Ally Financial. Michael is going to be in our analyst development program. He graduated from NC State back in May of 2019. He has a BS in business admin and finance, and also played on the club soccer team, which is interesting. Michael is a CFA level 1 candidate, and like I said, he's joining our analyst development program, and we look forward to great things out of him as well. So virtual welcome to both of those members of the team, and excited to have them with us. So move on to the budget recommendation, Mr. Chairman. And just so everyone knows, kind of get an idea of where we are from a budget perspective as far as what the General Assembly is doing right now. The General Assembly passed, before the end of last fiscal year, the General Assembly passed a continuing resolution And that continuing resolution is still in effect for the current fiscal year that we are in. So the 2021 budget year that we are currently in, where all state government is operating under a continuing resolution. Basically, what that means is that state agencies are authorized to expend the same amount of funds on the same programs, with a few exceptions that they were otherwise authorized to do in the previous year's budget. So it's as if, we're repeating, in essence, last year. That has, for the current fiscal year, that has no impact upon us because in our budget request, our budget request was for last year was exactly the same as the year before. So that has had no impact on our ability to operate or the amount of money that we can expend on salaries and operations. But it is time for us to submit our budget request for the 21-22 budget year. So I'm asking ultimately for the commission to allow me to submit the budget request that I'm going to detail below. But just to give you a bottom line up front, I'm asking, would be asking for no changes to the amounts that we asked for 2021, which are also the same amounts that we asked for 1920. So first slide you see, that's our organizational chart. We have a couple of vacant positions. The ones that you see to the far left in the junior analyst program those are to be expected. That's a continually rotating program. We have people come in. Sometimes we have people leave they find opportunities in other places. And sometimes we are able to use that as a ready bench to turn to when we need people to fill permanent full-time positions. So we expect there to be always a little bit of churn in that, but we have at this point we have 8 positions dedicated to that program. We've been thinking about whether or not that's the right number, but that's what we have right now. We do have a potential hire in the both in real assets and in private equity, but we're still contemplating whether or not how we're going to fill those at this point. The next slide is just a recap of our 5-year appropriations history. As you see, we've gone from about $17.3 million in authorization down to 15.3, and that has been due to us over the course of several fiscal years asking for a reduction in authorization. We're not asking for either an increase or a reduction this year. We're just asking to be for the General Assembly to maintain our same level of authorization. Our current funding, $15.3 million. That breaks down into $7.2 million in personal services, employer contributions of $2 million, and then other operating expenses of $6.1. Some things that we expect for the 2021 year, filling some of the open FTE positions. We've continued our expansion of the Alborn Consulting relationship. We've added their hedge fund service, and that has been a wonderful addition to that relationship. We've had some additional costs with our co-sourcing internal audit function, and we have some continued expenses with the acquisition of the build out of our CRM system. For 21-22, again, we're requesting the same amount as 21-22. We're not requesting any additional FTEs, nor are we asking to give back any FTEs at this point. We're currently authorized 51 FTEs. We have 44 filled. As you can see, the breakdown of the vacant and where we would potentially place those at this time. On the next slide, we are requesting to maintain our exemption when it comes to the custodial banking relationship. This exemption has been in place for several years since the pension reform bill was passed and the control of the custodial relationship was passed to us. We feel that we've been able to use this exemption to leverage consolidating a great deal of services with the Bank of New York that has created not only operational efficiency, but also a lot of fiscal efficiency as well. So we're just asking that that be maintained in place so that should other opportunities arise, which we think that they will, that we'll be able to add those services without having to do an RFP for the custodial banking relationship. And that is it, Mr. Chairman. Again, just to recap, asking for the same amount as last year, not asking for any more, not asking for any less. Just ask that there's a motion associated with that, basically authorizing me to submit our proposed budget to the governor's office. Back, Mr. Chairman, if
I'm sorry, I was muted.
unless there's any questions,
Mike?
which I'll be certainly. Yes.
It's Ed. Can you hear me, Mike?
Yes, sir.
Mike, the proposed increases in salary for the teachers, does that necessarily increase contributions to the fund?
Yes. The way that we amortize the unfunded liability, Ed, is, it's a level percent amortization method. So any increase in total salary will result in an increase in contributions. Yes.
And
By the
does
same.
does that go to our budget, or does that go, as I think you just said, that would go to decreasing the unfunded liability?
Well, that our budget is basically just an authorization for us to expend $15 million to operate. But the additional if, for instance, when any state employee, whether it's or any employees that are in the system get a raise, whether it's a big cohort like the teachers or an across the board raise, the increase in contributions associated with that flow into the trust. And if you think about the employee contribution, that's going to really to pay for the employee's benefits. The employer part of that contribution is going to help pay down the unfunded liability. Is that responsive?
Yeah, thanks.
Okay.
Hey, Mike, this is Peggy. I would just point out that while those additional contributions do help to pay down the unfunded liability, as increases are granted, depending on whether those increases fall within our actual assumptions or not, they can increase the liability if they are outside of those assumptions.
Sure. Right. Yeah, it's really, the impact, Ed, ultimately there's some natural, kind of payroll growth factor that's built in. So it really, a lot of it just kind of depends, as Peggy said. All right. If anyone else has any other questions, be more than happy to answer them.
All right, there being no more questions, I'd like to call for a motion. I'm going back and forth between being muted and unmuted. I don't know why that's happening, but I hope you all can hear me. I'm calling for a motion that the commission authorizes the CEO to submit a proposal for fiscal year 2022 detailed budget substantially similar to the draft budget presented for inclusion in the governor's annual budget.
So moved.
Second.
We have a motion and a second. Any further discussion on this issue? Hearing none, I'll call for a vote. All in favor, please say aye.
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 Any opposed, please say no. The motion carries. Thank you. Next, I'd like to recognize our Chief Investment Officer, Mr. Berg. Go ahead.
Mr. Chairman, before Mr. Berg gets started, and just a couple of things that I would like to, to say to introduce the topic, because Jeff's going to spend a pretty good amount of time talking about fiscal year investment performance and especially I think we all know where we were after the third quarter. I think he's going to spend some time talking about the impact of the fourth quarter, but also, talking about the changes that the substantial changes that we have made to the portfolio as part of the implementing the 5 asset class portfolio. But I think, before we do that, I think it might be a good time to really place these comments in context, because the portfolio that we have today, that we have right now, is substantially different than the one that we had at the end of the fiscal year. And, that was the result of a lot of hard work by both the commission and the staff to get us to the point where we could implement that simplified portfolio. I think we're getting a good bit of feedback. If everybody could mute. There we go. But I think, kind of taking just a minute to take a look back to where we were and where we've come. We started the process of looking at simplifying the asset allocation beginning in 2019, and really trying to make the determination as to whether or not we felt that we had too much complexity in the portfolio, and really trying to think about what was the portfolio. Was there a way to both simplify the composition of the portfolio and simplify the means of implementation, and so that we would end up with an asset allocation and ultimately a portfolio that we felt comfortable holding for decades rather than years, because we are an investment organization that has the longest of investment horizons. And I think one of the lessons that we've learned is that, the desire to tinker with the asset allocation kind of on a yearly basis, and the outside pressures and forces that you can, I think, fall prey to that encourage you to do those things, had really gotten us to a point where not only did we have a great deal of complexity in the portfolio, but it was also something that we had changed pretty much on a yearly basis, and that was probably not the best course of action when it came to having a portfolio that we felt comfortable that would deliver us the type of return over time that we need to help make the plan work. And I would submit that we were methodical in the way that we went about trying to determine what was the best asset allocation. As we sit here today, the one regret that I have is I wish that I would have pushed harder, because of what happened in March, to get us to the point where we would have had that implemented. But, these are the types of changes that, one, I think we needed to be mindful of the fact that we didn't need to make changes simply to chase return, and that we really wanted to make these changes based on foundational principles that we thought would lead us to a portfolio that we could hold over a very long investment horizon. Unfortunately, that portfolio, the simplified portfolio, would have done better during the market turmoil of the first quarter. We would have had a much better fiscal year. I think our estimates are that we would have had a positive, even using our private market returns for private equity, private real estate, and private debt, we'd have had a positive 2.5% rather than a negative 1.5% return. There's obviously a certain amount of shoulda, coulda, woulda in that, but there is a degree of comfort knowing that I think we were on the right track, but we were trying to be thoughtful and methodical in the way that we did it. And, but the news is we have that portfolio in place now. I feel comfortable with the fact that it is a portfolio that I believe that we can hold, maintain, and consistently apply over the course of a long investment horizon. And, I think we have positioned ourselves to be in the best spot that we can be, or the best position that we can be to manage this plan well into the future to help maintain the safety and security of the retirement system. So, I think it's good for us to look over the past fiscal year, figure out what went right, what went wrong. But I also think that we need to take a minute and think about where we are. We're on a much different path, a much simpler path, but I believe that much simpler path is one that we can consistently maintain. And if we are consistent and we are patient and we have the longest of investment horizons, I believe that will serve us much better than where we were. So, that being said, I will turn it over to Mr. Byrd.
Okay, and I will fill in the gaps.
Right.
Yeah. So before I get into the details of the last quarter and the whole year, I do want to express my gratitude to the Commission for embracing a few initiatives last year, each of which I believe very strongly will play a big role in improving returns. Last year, this really makes last year an important transitional year in a few areas for us, and let me give you a couple points on what I'm referring to. As Mike just alluded to, we have obviously simplified our top-down portfolio design, and in so doing, we wind up eliminating a handful of asset classes and really shifting our focus to the major exposures that really over time are going to drive the returns for the system. Second, the Commission allowed us to expand our use of passive index strategies. Today, as we sit here, we are now indexing our entire public equity portfolio and a significant portion of our fixed income exposure as well. The impact of this is huge. These are some areas where we've had challenges with our manager performance, and by shifting to passive, we believe that we're going to not only improve our returns, but we're going to be in a position to reduce our fees by nearly $50 million a year doing it. And finally, we conducted in December, we closed a private equity secondary sale, and this is important for a big reason. When we combine that with the co-investment program that we've been building, these are two things that are really going to help us accelerate not only our allocation to private equity, but the quality of our private equity is improving more quickly as a result. So even though it was a year that had its challenges, it was an important year in terms of the progress that we were able to make in some very, very meaningful areas. And I want to make sure that we take stock of that, and I express my gratitude for the Commission's willingness to make those changes. So let me move into our performance summary. It was a very good quarter that ended in June. We were up more than 10%, 2.7% better than the benchmark. For the whole year, though, we trailed our benchmark by 1.7%. I'll shed more light on that in just a minute when we get into the analysis portion. Here we can see the systems paid out $4.2 billion during the year against $3.6 billion of deposits, as well as a $110 million legislative inflow. All told, our net payout was shy of $500 million. Our negative 1.7% return is shown here on the right. I'm sorry, 1.58% return is shown here on the right. And we ended the year just shy of $31 billion of plan assets. I won't go into too much detail on this page, but one thing that stands out when you look at returns of asset classes over the course of the year is a real significant divergence between higher risk, higher expected return, and lower risk, lower expected return asset classes for the year. The lowest risk investments, other than cash, were core bonds and TIPS, and they outperformed really everything else by quite a wide margin. Here we have our standard compliance look. You can see on the right-hand side, we had equity options and GTA exposures that were technically out of their allowable ranges on June 30th. However, I would just point out that this is simply a reflection of us building toward the portfolio on July 1st that no longer included these exposures. So let me shift to our performance analysis framework now, and let's dive in a little bit deeper on the returns. So let's start with the bottom line for the quarter and the year. As I mentioned, very good quarter in the second calendar quarter of the year. But even though we had a very strong finish to the year, it didn't fully offset what was an extremely difficult first quarter of 2020. As a reminder, during the onset of the pandemic, we were overweight equities, overweight credit, and underweight the lower yielding, safer investments that I just shared with you have performed quite well in recent times. Although this was exceedingly painful in the first quarter of 2020, the opposite was true in the quarter ending June. And fortunately for us, we've maintained some of this positioning since June, and the recovery has continued. During the year, our public market managers had very challenging experience, which I will get into more detail in just a moment. The other big picture theme that I want to highlight relates to energy. A very strange thing to point out, but on April 20th, we saw oil close at negative $37.63 per barrel. You had to pay somebody to take oil on April 20th. This really had an unfortunate effect on a lot of energy investments in it, particularly equity and credit investments in energy, that really this added to the already elevated anxiety level of investors and has had the effect of being sort of a wet blanket on their recovery. Finally, we were extremely busy, as Mike alluded to, during the quarter. At the April meeting, we adopted what we refer to as the simplified asset allocation. Since then, we've not only been working to align the portfolio with the new targets, but as we mentioned, we've also completed a shift to passive for our public equity portfolio. And I want to single out, well, I guess I'm not singling, I want to lavish some praise on some people internally. Brian Moore's team worked very hard on both these projects, both bringing the portfolio into alignment with the new targets, as well as simultaneously taking a large part of our portfolio passive. And I'm proud of his team's efforts to get this done before the new fiscal year. This asked a tremendous amount of he and his team, not only them, also our operations team that needed to arrange for all of the cash flows, the reporting team that had to kind of rethink the portfolio structure and how we present it. And all of this got done at a time when people were working remotely. So it was a logistical riddle. And from my perspective, the way that our people solved it is a testament to their hard work and their thoughtfulness. And all in all, just to give a sense of scale to this, we moved We had more than $13 billion worth of transactions in a little more than 60 days. So quite an achievement. Let's move into the framework here. As you can see, the reference portfolio outperformed our policy benchmark due to what was really an exceptional year for investment grade bonds. As a reminder, the reference portfolio is 30% of the Bloomberg Bar Cap Ag, which is core bonds. The value from diversification as of June 30th, which you can see in the second row, is negative for all three of the trailing time periods. I think it's important to point out 3 months ago when we looked at these numbers, they were all green. And with the volatility in markets driving this reversal, this is a good example of endpoint bias, which in a few minutes our friends from Makita will talk about. Another thing I want to point out is our portfolio has fallen short of the policy benchmark by 1.7% for the year. And when you look at the longer time period, this 1 year performance is essentially explaining nearly all of the 3 year shortfall. During the quarter, as I alluded to, we saw some big reversals in terms of several impacts in what we call the portfolio structure decisions. The private equity and hedge fund impacts that you're seeing here that are very large reflect the universes of private equity and hedge funds outperforming our benchmarks. We did remain overweight public equity and credit in the aftermath of the aftermath of the March quarter for the entirety of the second quarter, and that positioning very much has helped as well. Here we go on manager selection. We see a positive skew to our experience during the quarter. Another case of what was challenging in the March quarter has been working well since then. Our public equity and credit portfolios recovered very nicely versus their benchmarks, and you can see that here. I'm going to not read to you everything on the page. I'm happy to answer any question on anything, but in the meantime, I'll keep going. Here is the graphic that shows us the full year. A couple of themes. I'll spare you trying to decipher this. I'll give you the themes that I think are the dominant stories for the year. Portfolio positioning at the beginning of the calendar year was challenging and magnified the pain from the onset of the pandemic. Being overweight equities as that began was contributed very negatively. We were underweight core bonds as well, and that, as I've shown you, was the best performer for the year. Over time, that's positioning that can work, but it was very costly during the 6 weeks at the onset of the pandemic. We were in a strong liquidity position, thankfully, and we have maintained those positions since. I'll get to that in just a moment. What you're seeing here also is as outperformance in public equity is coming from our equity options portfolio, and I think it's important for me to note that the excess return in equity options has been tremendous. However, the beta of equity options has not been great beta for us. The other thing I'll point out, what we refer to as other assets here, is our GTAA portfolio and other opportunistic, both of which were pain points during the year, both of which are no longer in the portfolio after June. The other opportunistic portfolio housed some of our energy exposures, including MLPs. We did benefit in the quarter from a strong recovery in MLPs, but we sold out of that position in the second half of June. Here we have our excess returns our manager performance over the past 3 years by asset class. In light of the portfolio simplification initiatives that we've discussed, I thought it would be most helpful to look at this a little bit differently. First, there are certain exposures, and we show these here in blue, that are just no longer a part of the portfolio, and are that includes equity options, GTAA, and other opportunistic. Asset classes in green are those where we've made some pretty meaningful restructuring decisions in public equity, going passive, in private equity, the secondary sale in December, and in hedge funds, we've really done some restructuring around putting ourselves in a position to generate more consistency in our return, as opposed to high magnitude of return. So the final thing to note here is we do have a couple of asset classes that we expect to use less frequently, and these are in gray. These are the spread sectors in fixed income. And at the end of the day, when you look at the things that are changing, I believe these changes are going to leave us with a portfolio that has a more persistent and less volatile excess return profile. So let's quickly look at asset allocation. We began the new fiscal year with a slight overweight to public equity. We continued with this positioning oddly until 10 days ago, at which point at the end of August, we rebalanced back toward our target weight. We also began the year overweight private debt as well. These overweights were offset by an underweight to bonds. Now let's look inside our equity book. At the beginning of the year, we had a modest overweight to US large cap equity. You can see a very slight underweight to non-US equity as well. The rebalance that I mentioned a moment ago was targeted to bring the portfolio into alignment with the benchmark, both in terms of the amount of equity as well as the composition of the equity book. For the last couple of months, we've been doing some rebalancing, but this has been a bit like tuning an instrument to get these sub-allocations harmonized. Now the bonds portfolio had some intentional non-core exposures in it that I alluded to already. We're still carrying a small amount of high yield and emerging market debt exposure instead of core. These are the exposures that performed poorly in Q1 of this year, but we're being patient. And since March, that patience has been rewarded. But as these assets continue to recover and the prospective yields decline, we are revisiting these positions. And let me close with a quick look at risk. I want to point out, I'm showing you August 1st risk levels because we did have some portfolio trades toward the end of June that did not settle until during July, early July. And I wanted to show you a look at what the effective risks have been since those changes took place. Unfortunately, we don't yet have our actual portfolio information for August 1st. One of the changes that just took effect is that we made the decision to use Portable Alpha, an implementation decision that I make as opposed to a policy decision. And this has the effect of causing the volatility of the implementation benchmark to be higher than that of the policy benchmark. So I wanted to make sure I noted that differential for you. As far as the tracking error is concerned, there are three factors that account for almost 90% of the tracking error between our implementation portfolio, which is sort of the top-down decisions, versus the policy portfolio. One, as I just mentioned, Portable Alpha, which we are running presently at right around 10%. The second is the positioning in the bonds portfolio I just highlighted. And then the third is a bit more nuanced. It is the composition of our real assets portfolio, where we do use some publicly traded exposures, and that creates some tracking error differentials because those mark daily. Actually, they mark minute by minute, whereas our real assets portfolio uses a quarterly benchmark. So I did want to flag that for you as well. And let me pause here and see if there are any questions.
Yeah, Jeff, it's Ed.
Yes, sir.
Can you hear me?
Yes.
Okay. Can you explain the difference between the reference portfolio and the benchmark in terms of measuring our performance?
Sure. So the back here, the reference portfolio is the simple 2-asset portfolio that is estimated to have the same level of risk as the policy benchmark. So that is a 70% global equity and 30% investment grade, U.S. investment grade bond portfolio. And it behaves differently, certainly than a portfolio that has, I believe our policy portfolio had 19 asset classes.
Yeah.
So we do like to highlight the impact of those risks, but also looking at those returns over time. Is that helpful, Ed?
Yeah, if I understand you, then the reference portfolio reflects the policy portfolio?
Nope. That's the second box on the top row here. The reference portfolio is just a simple 2-asset portfolio that we believe has over time the same level of risk as the policy portfolio, but they're two separate portfolios.
So that reference portfolio doesn't change very often, if at all. Is that right?
Correct.
Yeah. Okay.
Yeah. And the intent to Ed is for the policy portfolio not to change very often either. On a go forward basis.
Yep.
With the new simple 5-asset class portfolio.
And
Other
one question, as far as the benchmark is concerned, that does change from time to time. Is that correct?
It has changed, and that's Mike's comments earlier reflect our hope that is something that is going to change very infrequently on a go forward basis, but it has typically changed. Maybe not every single year, but most years in the past.
And what is the criteria for changing that?
That ultimately, Ed, that's a commission decision. If you think about, if you're looking at if we think about kind of who owns what as far as decision making goes, the commission owns obviously the commission owns everything, but as far as decision making goes, the commission really owns the reference portfolio and the policy benchmark. I think we have built into the SIOP that we'll look at that policy benchmark and the reference portfolio that the commission will, I believe, every 5 years. It's either every 4 or 5 years. And if you think about the implementation benchmark, that's where Jeff and the investment team that's more portfolio structure. So that's where they're maybe structuring the portfolio a little bit differently than the policy benchmark. And then obviously the ultimate return is a function of both how the portfolio is structured and how the quality of our manager selection. So when you combine those two things, and those are owned at really kind of at our level more. So that's the breakdown. But I think we would be looking to do like we were, I think, in a kind of a constant hamster wheel of doing a full asset allocation breakdown and review every every fiscal year whenever we would get capital market expectations. I mean, my desire is to break us from that habit and to really think about asset allocation over long periods of time. So that policy portfolio should change. I would, submit should change very infrequently. And that it's worth a review every 4 or 5 years, but we can check in on the health of it as far as when we get capital market expectations. But I think the one thing that we've learned is having any policy portfolio over a longer period of time is better, and holding it will yield a better return than constantly changing it.
Thanks.
Other questions?
Hey, Jeff, this is Peggy, and it's really not so much about the performance as it is about one of your earlier slides where you showed the cash flows into the system. And we can get together later about this, but the numbers that you have are both deposits and requisitions are significantly greater than what our contributions and benefit payments are. For the fiscal year, we collected in contributions about $3.1 billion and we paid out about 3.6. So I'm not exactly sure what's being double counted there, but we can get together later and go over that.
No, that's great. I appreciate that. Apologies for the misstep on that.
Well, that's just, I know that we'll be producing our financial statement, so I don't want anybody to think that we paid out $4.2 billion in benefits this year, because that would be a significant increase over benefits from last year. So we'll get together and resolve what the differences in those numbers are.
Okay. Thank you. I appreciate that.
Okay, are there any other questions for Jeff on the review of the investment performance that we've had? Having none, I'd like to turn it over now to our CEO and let him make introductions for a presentation that we're about to receive. Mr. Hitchcock.
Thank you, Mr. Chairman. I'm looking forward to the presentation that we're about to receive from Makita. The presentation is on, the topic is endpoint bias, and I think it is a very timely discussion, given, my comments and the changes about trying to maintain a level of consistency and patience. I think that the topic in regards to the portfolio, I think this topic dovetails very well with, trying to make sure that we are judging our performance over the longest of time periods, and that we're not influenced one way or the other by endpoint bias. Because ultimately, I think what you'll see is where you strike that cutoff can have a great deal of impact on your result. So I'm looking forward to this presentation. I believe Leroy is going to lead, and I think Peter will also be jumping in, but I will turn it over to them. And gentlemen, if you just tell me next slide, we'll drive for you.
Perfect. This is Leroy Brantley. Can everyone hear me clearly?
Yes.
Very.
Oh, great. Super. Thank you so much, Mike. If we could just move over to slide 2, we have a brief description of what endpoint bias is. And endpoint bias is essentially a place that we see greatly in our field, because we look at things particularly in performance and risk over annualized periods. And endpoint bias really tells you how important rolling on one time period can be. It could be a year, or it could even be a quarter or a month in terms of looking at those elements of performance and risk through those annualized periods. But one of the things that has been highly evident over time is you really get a chance to see endpoint bias manifest itself after corrections in the market especially after one thing has been doing particularly well in the market. There's some complacency that can occur from that. And you can have another sort of asset class, if you will, that has been performing very poorly over a time period, which may preclude it from consideration and not have other elements of evaluation come into play. So as I just mentioned, this really becomes highly evident during corrections. If we can flip to page 3, we have a comparison of growth and value managers here. Growth and value as an asset class, I should say, and this is the large cap side with the Russell 1000. I should also tell you this part of the presentation, we're not going to go through every example in here. We're just going to highlight maybe 3 or 4 and talk about its impact on investors' decisions. This highly resonates with me because I went back to grad school to get my MBA. After teaching for most of my 20s, I entered school as a 30-year-old, watching this new sort of tech boom unfold in the late 90s. And it was the growth managers that were really taking off because everything that was happening during these time periods were based on what was going on in the internet and what was going on in terms of technology. And I focused on internet companies and technology companies, in particular semiconductor and semiconductor capital companies. And I watched this elevator just go up and up and up. And, if you were a consultant, you were really finding yourself going to quarterly meetings defending having value managers that were growing by high single digits to teens, while you had growth managers that were growing by 50% and in some case triple digits during the boom. And that became a constant sort of battleground. But if you flash forward to the 2001-2002 period, you had a chance to see how important it was to have those value bias managers in the portfolio. And they were the ones that actually protected capital, and in some cases that even made money. And Warren Buffett went from being considered a dinosaur who was out of touch with the quote unquote new economy to becoming a genius again. And what we saw during that time period was that investors that resisted the urge to terminate the value managers found themselves in a much better position in terms of the portfolio. And just to give you some sort of color behind this, the NASDAQ during 2000 and March in particular was at 5,000. And it took, during that 5,000 period, it only took 3 months to grow from 4,000 to 5,000. And if you were to look back over a 5-year time period during that, the NASDAQ was up over 400% from 1995 to 2000. And, this move created a huge advantage over value stocks. If we look at the period leading up to 2000, we see, there's 130 basis points of annual advantage by the growth managers. That doesn't seem like a lot, but over a 20-year time period, if you were investing in those two asset classes, you would have had a 30% more cumulative growth over that time period. And with that being said, the mindset then was we need more growth in the portfolio. We need more growth in the portfolio. Then you move forward and you see to 2000, value actually moves ahead by 210 basis points by having, and I had a friend that worked at a private equity fund. It was Bain, it was Sankaty Advisors. And he said, it's really hard to go out and convince clients to invest in bleach companies when you have all of this great stuff going on in tech. But if you move forward to 2001, and same time period, and we purposely use a 20-year time horizon, because you remember back then, you know, a full market cycle was considered 3 years back then, where you would have some ups and downs and whatever. But here during this time period, you did not have that. All right. But just rolling off that 1 year at the end and putting on the new year, 2001, you will see a difference of 210 basis points. And over a 20-year time horizon, that 210 basis points would give you a 50% more cumulative growth in market value just by being in value. So it shows here just how rolling off the last 9 months of 2000 and rolling on the last 9 months of 2000, rolling on the first 3 months of 2000, how investors gained a greater appreciation for diversification, and how important it was to have that value piece in there, how important it was to have asset classes offset each other, and how important it is to also rebalance, as opposed to just letting this run and having the market rebalance for you. And if we move over to slide 4, we see a similar occurrence for the global financial crisis that had occurred, where many investors had been questioning why even have bonds in the portfolio. You know, we're on a steadily riding up elevator. Once again, the complacency element comes into place. And I still can remember during this time period, we were looking at hedge fund managers that had some fixed income element. A misnomer was being used for these types of hedge fund managers. They were called absolute return managers. And I still remember a head of research saying, you know, the only thing that's absolute is that you're going to get a return, and that could be a negative return. But what you did see was hedge funds were being funded by allocations previously tagged for fixed income. Going into this 2008 period here, you will see that the S&P was performing essentially 45% better annually. Yet, if you bring on that next year, and that's better than core bonds, I should say, you flip over to the next year and you'll see, as with value managers, investors regain recognition of the role of bonds in the portfolio. Because if you go through the global financial crisis, the only thing that held up during that crisis were bonds. And you know, so that put another sort of lens on how important it is to extend out these observation periods to see how bonds performed when there were smaller corrections in the market. And so much so, when you look at this, what had begun as a 340-point annual deficit had really become a 20 basis point advantage, with just a year rolling off and rolling on to that performance. And we do give you the note here that this 20 basis point performance was an anomaly that really lasted for just 1 month. But the important factor here is that if investors kept in mind what the role of bonds were in a portfolio, and that is to provide money for when deflation occurs, but also to act as a diversifier for equities. If you had that portion in your portfolio and kept rebalancing to keep that at a reasonable exposure, you came out of this not as badly off as others. So if we can flip to page 5, we get a chance to look at this through a much shorter window of 5 years. Okay, and I'm getting some feedback. Is that just me, or can you guys hear me clearly still?
Yep, you're good. Thank you.
Okay, great. So if we're looking at this through a 5-year window here, you see that growth was outperforming by 1,000 basis points, and then a year later, just rolling out, this is 1 year, you get a chance to see this value come up and take over the lead by 260 basis points. And, okay, something, can you hear me? My screen is, hello?
We
Yes,
can hear you.
hello?
We can hear you. We can hear
Okay,
you.
I'm getting something on my screen that says, hold on, looks like something is wrong and I'm not in the meeting. And I can't really see my screen right now.
Leroy, I'm here,
What I'll
so I
do
can
is-
take over while your screen comes back, if that's helpful.
Oh, no, I got it. I got it. So on page 5,
All right.
I'll just pull up. I don't have to see what you guys are seeing. All right. And as I said, page 5, looking through a much shorter window, you see how impactful rolling off 1 year, where it went from being, 5% of the time arising to being 20% of the time arising. You see that this is a much more drastic switch in terms of leadership here. And when you look back over time, as I mentioned, March of 2000, and NASDAQ was at 5,000. It took until 2015 to get back to that number. But if you're asking people what were their thoughts of the NASDAQ being at 5,000, if you were to handicap that as a percentage, most would have said, 50% or even greater, because they expected it to be at that level, without taking a look back to see that it really took just one full quarter to grow from 4,000 to 5,000. And if you, once again, didn't have the discipline to keep value as an offset to growth in your program, you suffered some grievous drops in market value. So with that being said, one of the sort of investment adages to keep in mind when looking at an element like endpoint bias is that history is not a prologue. And you'll see this in just about every investment manager's prospectus. They will say, historical performance, there's no guarantee, and future performance, history is history, and this is how we've done. Let's assess us here. But one of the things that comes up a great deal in terms of manager selection is looking at how these managers have done over 3, 5, and 10-year time period. And everyone wants the manager over that time period that appears in the Northwest quadrant, where there's a higher return and less risk taken on, without looking at what's going on in the market. So sort of the wiser approach to this is to look at longer time periods for the managers and determine if they're regularly appearing in the top quartile or above median, if that's something they have a competitive advantage that's not driven by market beta. If they have that competitive advantage and they've been able to repeat top tier performance, those are the managers you want to give a longer look when they're not performing as well, because we all know that over a 10-year time period, any top quartile manager is destined to spend at least 3 of those years in the 3rd or 4th quartile. So, it seems counterintuitive, but having a manager that's not in that Northwest quadrant that may be doing less well than other managers in the program that are being lifted up by market environment, you really want to give those good managers in a swoon a second look, because it's actually better. It's a much better opportunity to come into those managers when they aren't doing as well as the others, because you would essentially get into a cheaper portfolio, and you would expect them to get through whatever the market environment is that's working against them, and then go back to a market that's driven more by fundamentals, and then add to the performance for the overall portfolio. We do have an example here on page 17 where we look at high yield bonds as an example. we give this as an example because this is one where opportunity comes into place. And this is one where you get to see the similarities between endpoint bias and recency bias. And recency bias is actually a component of endpoint bias because you are driven, most investors are driven by what is currently going on and why they feel, one of the sort of elements that you have to have as an investor is maverick risk, where you're willing to go against what most other investors are doing because you have something in your evaluation process that points to an opportunity that others feel would be very risky. And one of the places here, as I just mentioned, was high yield, and high yield coming out of the global financial crisis, as you may recall, S&P was down 40% during that time period, and high yield bonds that have a very high correlation to the equity markets, if you look during this time period, was down 31.2% and down even over a 5-year time period by 2%. And the converse there would be the core bonds were up 1.7% for that year, which was big. Once again, when you're looking at equities down 40%, you have something, a place where you're making money. And over that 5-year time horizon, up 4.1%. But if you were not looking at high yield as it's should be looked at, it's a value-added form of investing in fixed income. If you were not taking consideration of how wide the yield spreads were, you would have missed a great opportunity to have a 65% gain in your program by an asset class. And that, as you see, boosts up that 5-year number, which just a year earlier was negative, to a 6.1%, and it lifts up going through this whole time period here. So it's very important, as Jeff mentioned and as Mike has mentioned, to keep a long-term view on how you address your investment portfolio, and not get caught in a trap of performance chasing and doing what's hot, and probably, and as in this case, avoiding what had been negative, but with a very good explanation of why it was negative, and having the intestinal fortitude to follow your convictions and say, hey, this is a great tactical investment. I don't think we're going to see high yield spreads this wide again. The return opportunity definitely merits the taking on the risk here. And many of our clients did take advantage of this window in the market. So in terms of how we look at avoiding endpoint bias, we have some points here on page 11. And the most important piece, as Mike was just touching on, is to always extend the time period out to the longest time period available, so that you can go in and dig in and see how these investments perform during many periods during that time cycle. The most important piece here, as I just went through the high yield piece, is understanding what the factors are that are driving these certain market opportunities during these time periods, and how sustainable that is, or more importantly, how temporary they can be. The most key point here is to keep in mind that we're long-term investors, that this portfolio is going to be around. It's built to be around and planned to be around much longer than any of us will be sitting around that table making decisions on the portfolio. So you keep this in mind when you're risk budgeting. You keep in mind that the most important goal is to achieve the optimal risk-adjusted return. So in some cases, you're going to have to play defense and not stay around, you know, at the poker table, so to speak, until your chips start vanishing from in front of you. So it's very important to keep in mind the disciplines of rebalancing, and it's very important to keep in mind what your long-term strategy is. Your long-term strategy is, you know, is something that's not meant to be changed often, hence the long-term part of it, but it's something that should be reflected on periodically to make sure that you're still staying the course. And, you know, most recently, we had a chance to see how important it is to evaluate the risk assets in the portfolio. And we saw that two ways. We saw it one way, wow, this is getting pretty big, you know, leading up through March, up until March. But it's also looking at it when the correction happened and seeing how your defensive parts of the portfolio played. It's important to also look through that lens and say, okay, now we have, you know, PEs are at this number here, and now it may be a great time to pile back into some real assets and get back to our target allocation. So as both Jeff and Mike said, this is a very timely place in history to review endpoint bias. I hope that you got something out of the presentation here, and I'm more than happy to answer any questions. And Peter's here as well.
Yes, question going back to your discussion on high yield. Obviously, it makes sense to take advantage of high yield when the spreads have widened out appreciably. What happens taking the opposite view when spreads narrow to a point historically where they're very narrow relative to high quality bonds? That's one factor. Should we be looking at that as a tactical opportunity for change or more strategic, taking your suggestion about taking a long-term view? And in addition, when spreads narrow dramatically on high yield, does that correlation to the stock market still hold? And is that an indication that the stock market is overvalued at that point?
Yeah, Peter, do you want to add anything here? I have my view.
Yeah, Leroy, you could start and I'll add some color.
Oh, great.
Yeah, I think,
so,
go ahead.
No, you go. I'm fine. I can.
All right.
You want me to?
Yeah. So,
okay.
Yeah, you could start and then I'll add some color. That's great.
Okay. All right. Wait, it feels like who's on first here. All right, here we go. So, and looking at this, I typically view high yield as a tactical position in most portfolios. Many, I would say, most of my clients do have a strategic allocation to high yield. In terms of the spreads dictating movement, for those where it is a tactical play, those would be the only time I would consider high yield for the value added bucket as opposed to the core fixed income bucket. And conversely, when those numbers come down, the spread narrows, I'm actually looking for other opportunities in the portfolio that may be more of a diversifier to equity, because that most likely means that the equity markets, to your question, are doing quite well. And I'm looking in this case to maybe play more of a defense and have more of my fixed income exposure be more on the core side, more on the defensive side than taking more of an active risk there with that exposure. That would be how I would say it in very few sentences.
Yeah, that's great. And I would just add a little color. I think each plan has a different view on how long-term strategic they want to be and how short-term tactical they want to be. And so that's where you could have varying degrees of action taken. This presentation is designed mostly to talk about some extreme situations when valuations and returns are extremely different between growth and value, between investment grade and high yield, et cetera. So they make much more obvious examples where, geez, how do you not take action in the face of this? But some investors choose to be more tactical and act more frequently. Like some of these examples happen, just once every 20 years. But the short answer is, I think that your approach that you're taking right now does position you well to say, we don't need to be taking a lot of extra risk unless we're being paid for it. So if you're not being paid well for high yield, you have a reference portfolio that you're inclined to be with unless you're being well compensated for some of these other spread asset classes, I guess. And so, this is really just highlighting the approach and in some ways warning. I think it's a warning because many folks just look at returns and draw conclusions from it, saying, in the one example here for high yields had, back in after 08 was trailing investment grade bonds, not just for 1 year, not for 3, 5, 7, 10, 15, even 20 years. So I think a lot of people could look at that and say, why own high yield? They've trailed for 20 years. And this really, endpoint bias, tries to help people don't make rash decisions just on one endpoint. Look at, and then it gives a number of strategies to make sure that you're not making a poor decision just based on one endpoint and one data point, but looking at, and this is where it gives, examining the longest periods available, also look at underlying periods. So without going through them all, it highlights a number of different things to do, but also look at the fundamentals. Don't just look at the past returns, look at, well, what are the projected returns and the fundamentals? And back then, in the high yield example, high yield spreads were 20%, 2,000 basis points above treasuries. So you're being well compensated at that point. So even though they trailed, it's hard to imagine that they wouldn't outperform when you're being paid that much more for them. And sometimes it draws then the opposite conclusion. If you just look at past performance, you would stay away from high yield. And if you had any exposure, you'd sell it all and get away from it. If you looked more broadly at other things and didn't just look at that endpoint data and looked at more valuations and other underlying drivers of the asset class returns, you'd look at it and say the opportunities here are fabulous. And that's what it turned out. You got a 65% return in the next year. And so your point on the lower side, it is a fair one as well. If certain asset classes do so well, and on the bond side, that means their yields are driven down so low. And if it's high yield, the spreads compress so tightly that you're not really being compensated. And you shouldn't really look at the 1, 3, 5, 10, and 20-year returns, especially for bonds and high yield. You should look at, well, what's the driver of future returns there? What are the yields? And what are the spreads above treasuries? And if those get really tight, forget about past returns. Don't expect those. Expect more of a fundamental approach. So the short answer is yes, it's not unreasonable to look at it when spreads are really tight on high yield to wonder, should we invest there? Are we being paid enough? And in some ways, your approach right now with your reference portfolio is designed well for that. It doesn't really drive you at a base case into high yield. So high yield has to be attractive enough for you to deviate from your reference portfolio. And so I think in a way, your design, it's well designed and only taking on those extra risks if when you're looking at it, as Makita highlights here and your staff does as well, from a multifaceted approach, and it makes sense and you're being compensated, let's deviate from the reference portfolio, take more risk because we think we're being compensated for it.
Okay, just to take it one step further, if in evaluating the risk factor in high yield, hypothetically, if spreads get to 300 off high quality or at 500 or 600 off, does it make sense to measure those spreads relative to any historical? Obviously, you said you shouldn't just base a decision on history, but doesn't it make sense to look at where those spreads are and make a judgment on, say, where spreads have been historically, whether 500 or 600 is historically extraordinarily wide, or 200-300 is extraordinarily narrow?
Ed, that's exactly the way that it's working now. What you're describing is, and I'll give you the threshold. We get interested in high yield, in changing from ag to high yield when we get to 500 basis points wide of treasuries.
Hello? Hello?
Ed, are you there? May have lost Ed.
I think we lost Ed.
Can you hear me now?
Yes.
Ed,
I can hear.
Ed, we
I can hear whoever's talking. Is that Ed?
Okay, go ahead.
Ed, I was just saying that what you're describing is exactly the way that it works.
I'm sorry, I can't hear you.
Ed, he's saying it's describing exactly how it works.
Yeah. Ed, can you hear me? I think we may have lost him.
Yeah. I think Ed's having some technical difficulties.
Yeah.
Yep.
I mean, I would say essentially, to answer to his question and to build on what Jeff said, we're saying, once again, history is not a prologue, but you cannot ignore what's happened historically to come up with statistics such as what is the average spread and where we are now, how many standard deviations are we away from that average number, that average spread number. So that's a data point in terms of evaluating what the opportunity set is. So it's not the only driver, getting back to what Peter said and what I said earlier in terms of looking at the fundamentals for the drivers, both historically and what we see may actually happen based on where a particular asset class is at any given time. And this also, as I mentioned, this also goes down to the manager selection level as well, in terms of looking at managers, in terms of looking what their relative performance is, and in terms of looking at what do we expect the market to provide as a backdrop for this manager to perform. Will there be other challenges that will keep a really great manager down, or are we seeing places where we think the obstacles as they are now will soon abate and hopefully, disappear if it's not, something that's a fundamental part of the market in terms of regular performance. I hate to use regular or normal now because those seem to be words of the past as we go through the sheltering, but those are all parts of our sort of toolkit in terms of evaluating opportunities. And, once again, you have to do it over as long a time horizon as we have the data to do so.
Can I ask a question here? Because to me, it's, I think, pretty material, right? I mean, we look for history as a guide, but that all assumes the risk-free rate is an accurate sort of rate, right? So I think where we find ourselves now is, credit spreads are at least in investment grade kind of at recessionary wides, but we're at historic lows, right? 99.9% of the data points lie to the north of us in rate land, right? That's forced a lot more money into equities, as people kind of hunt for yield. And so equities are well above even still any sort of long-term averages, right? Bonds, if the bond market just returned to the 10-year average, there's no return there for 10 years, right? On a 200-300 basis point mean reversion, right?
Right.
So I'm just kind of curious, right? Like, Yeah, I mean, that's an asset class that accounts for, 40%, 50% of pension fund assets. I mean, how do y'all view that, right? And Jeff and I have talked about this a little bit, and Ed's question sort of had an embedded question in it related to what's the correlation between high yield and equities. And yeah, banks use the equity market to, hedge credit exposure and high yield because that's where most of their customers lie, right? But only 60% of the market might be debt issuing, right? I mean, you're seeing that kind of divergence this year, right? Any company that has a BBB credit rating is underperforming, the market. Those that don't have any debt or higher quality debt. I'm just kind of curious how y'all think about the opportunity set, because I think it is unique now that we've hit the zero bound, right?
Yeah. Do you want to jump in, Peter, or you want me to?
Yeah, so Alan, could you just then reiterate what point, because there's a lot there to hit on. I want to make sure I know. What's the focus on the question?
There's kind of two questions, right? So let's just start with bonds, right? We've hit the zero bound in rates, right? So, so arguably there's, other than if you think through the three big things: safety, liquidity, and yield. We got safety, we got liquidity, we got no yield. So it's a bad asset class, right? Then you got your spread sectors, which arguably look wide relative to that, but they're at historic lows because that first one is mispriced. It's kind of like, I call it the problem of the bad comp, right? Like, we got the subprime bubble because everybody was looking at the house next door, not stepping back and going, hey, this whole thing's ridiculous, right? Mm-hmm. And so, I'm curious how y'all are thinking just about bonds across the board on spread basis or absolute, because to me, if you even go back to 10-year, sort of the 10-year average, not even 20 years, right? 10-year average, and let's say it takes 10 years to get there, there's no return in bonds. I mean, we can already predict the endpoint, right? If it takes 10 years to mean revert, there's zero return, right? Because your starting yield's 2, right? And if your bond market now has a duration of 9, right, 200 basis point up is going to drop at 20%, right, which is going to wipe out 10 years of coupon, right?
Yeah. So I think a big question that you're asking about is expected returns going forward, and if they're low in certain asset classes, what do you do about that? I guess, right?
Yeah. I mean, it's we kind of have this history of including these asset classes, but I mean, this goes back to kind of thinking it through, right?
Right. Yes. Yeah, so it's a great question. There's a lot there. I'll hit briefly on it now just because I don't want to kind of overstep our bounds on the agenda, but we are actually doing a lot of work on this low interest rate environment, and we brought together a working committee to do some pretty interesting research. We have some findings there. We're going to continue with it. But part of the early punchline is obviously expected returns are lower now. It's driven by bond yields are lower, and most other asset classes are partly, their returns are driven off of bond yields and spreads or premiums above that. So across the board, most, if not all, asset classes have lower expected returns right now. And so then the question is, not just on bonds, but on everything. If your entire portfolio has a lower expected return, what do you do about it? For some investors, we could live with that and we don't need to or want to take extra risk. So it's just living with lower returns. When you have a lot of pension funds that have certain actuarial targets and funding issues and inability to just lower the expected returns beyond a certain point, I think many investors that in that situation are then forced to say, well, we're going to need to take a little more risk to get the expected return we thought we were going to be getting a year ago because the returns have dropped so much. And so it really doesn't apply just to the fixed income side. It applies, across the board to a number of other asset classes, because you could say, as much as it's unattractive to invest in bonds that might only have a 1% yield, you could also look at it, to your point, when you were saying, equities and other asset classes may be overvalued. So you could say then it's less attractive to invest in equities and other risk assets if you're not going to be paid as much as you were in the past, if expected returns are lower. And so, you know, part of the study that we're doing then is coming up with strategies. What do you do in this low interest rate environment? And without kind of putting it off to a future date, one of the strategies that we're looking at there, just to give you a little insight into some of the work that we're doing, is a barbell approach. And so as much as you say some of these bonds that don't yield that much aren't attractive, a number of investors would say we need a certain amount of stability in the portfolio. We need a certain amount of liquidity. But if we wanted a certain expected return, and we need some of those anchors, some of those lower returning bonds, it means then on the other end of the barbell, you'll need some of the higher returning asset classes. And potentially in that environment, it might squeeze out some of those asset classes in the middle, like high yield. And, you know, we had examples just 3 weeks ago. Ball Corporation, a high yield company here in the US, they just issued bonds at 2.8%. These are high yield. So these are junk bonds, and the expected yield, if they don't default, is 2.8%. And so that would be something in the middle of the barbell that maybe gets squeezed out as you start to say, well, we need some low risk investments, but they might only pay 1%. And we're going to need some things on the other end of the barbell, like equities, that can give us higher returns. But potentially it squeezes out some of those things in the middle. So as much as you think, geez, it squeezes out treasuries because they're so the yields there are so low, the barbell approach might suggest keeping some treasuries because they have some value, keeping some core bonds, the aggregate, you know, the ag bond portfolio. There's some value and stability and ability to have liquidity, et cetera, there. And maybe what gets squeezed out is high yield, especially if they're issuing things at 2.8% and there's a risk that they default. So it's a long answer, but it's a tough question, and there's a lot there. And we've put together this working group to come up with some ideas, and some of those might resonate with the commission and the staff, and others might be less appropriate. But we're working on that, and we're looking forward to sharing that with your staff and with you at future meetings.
Yeah, and Peter, I think that's a wonderful answer, and I think also, Alan, I think it's important because you're looking at it through a return lens, and this is why we categorize different asset classes into different groupings. One will be sort of the growth engine of the portfolio, where you have public equities and private equities, and particularly on the public side, you're looking at things, as Peter was saying, if you want to extend your risk out, this may be a time to go beyond what's in the ACWI index for your emerging markets, if you're reaching for a higher return. But when we look at bonds through a lens, and high yield, as Peter said, is sort of in the middle here, given the characteristics there. But if you're looking at core bonds and treasuries, the role of those asset classes, of those types of fixed income, the big return is not the key factor that's driving their inclusion. It's the protection that happens during deflationary markets and during corrective markets. So in your sort of best scenario, you don't want your bonds to be your top performer or even ranking up there in terms of comparative performance, because that means that other things where you have a greater exposure to in the portfolio are not doing well. I would, draw a comparison to your house insurance. You want to make that payment every month and not think of it as a waste of money because nothing ever happens where you're making a claim. Your worst scenario is actually having to cash in on that claim. So it's more of an insurance marker, the way we look at bonds, the core bonds and the treasuries. And, as Peter said, if you're looking at this through a barbell lens, pieces like high yield with tactical plays to them will fit somewhere in the middle that may get squeezed out by your reaching for a return, and also keeping in mind you want to play a good defense because when all of these corrections happen, you want to have a quicker recovery time, and a quicker recovery time is always defined by digging yourself into a shallower hole. And the shallower hole is determined by the high quality aspect of the portfolio. And in there, that quality piece is the defensive piece, and there firmly sits the roll-up bonds. Longer answer to your question, sorry, but.
Yeah, do we have any other questions for our folks from Makita? All right, gentlemen, thank you very much for your time. We appreciate your insight and your knowledge. What I'm going to call for, unless we've got some objections, is about a 10-minute break to stretch our legs, maybe go down the hall and get another cup of coffee. 10-minute break. We will come back at 11:22. Is everybody good with that?
Yes.
Yes, sir. Yes, sir.
All right. See you all back here at 11:22.
All right, thanks.
All right. All right, folks, by my clock, it is 11:22. I hope everybody's back from break. I'd like to turn it back over to Mike again to introduce our guest from K&L Gates and go into some fiduciary training. Mr. Hitchcock?
Thank you, Mr. Chairman. Just, periodically we have, we do fiduciary training for the commission, and it's been a little while since, I believe, since the last time that we had it, and we thought that now would be a good time for us to have some fiduciary training again. We have Margaret Niles, Wanhong Chang, and Andrew, I believe it's Fuchs, from K&L Gates, here to provide us with some fiduciary training. The K&L Gates is one of our, we have 4 firms that do securities litigation monitoring for us. K&L Gates is one of our firms that do that for us. So we look forward to their presentation on fiduciary duty, and without further ado, I'll turn it over to them.
Well, good morning, everyone. Just checking to make sure you can hear me.
We can.
Great. Well, thank you for the opportunity to join your meeting today and present on this important topic of fiduciary duty. Next slide, please. So as Scott mentioned, my name is Wanhong Chang, and I'm joined by 2 of my colleagues, Margaret Niles and Andrew Foyt, and we're with K&L Gates. The 3 of us are part of a group based mostly out of Seattle, Washington, that focuses on representing institutional investors. And we've been pleased to represent RSIC for almost 2 years now. Next slide, please. So we'll get right into it. We know you have a full agenda today. We have a number of slides to present today about fiduciary duty. We'll start with the basics and discuss the duty of loyalty and the duty of care, as well as other duties. And then we'll cover why fiduciary duties matter. It's often a key issue when trustees are sued and when trustees are dealing with problem investments, and managers in general just have fiduciary duties. So as a preliminary matter, a number of our slides and our discussion today is going to refer to a board and its trustees. And we recognize that RSIC is structured as a commission and its members are referred to as commissioners, and that historically RSIC has not used the term trustee synonymously with the term commissioner. But for our presentation today, we're going to use the term trustees and the board they sit on generically to refer to people who are in a position of having fiduciary responsibility for administration of an investment program. So when we refer to trustees, we're intending to include RSIC commissioners. So at this point, I'm going to turn it over to Margaret to start on the next slide, please.
Next slide. Hi, can you all hear me? Great. Thank you for the slide. Can everybody hear me? Just checking for me too.
Yes.
Great. Great, thank you. So, based on the introduction, we understand that you have had this kind of training in the past, and that we are, perhaps repeating things that you know well, but it is a matter of best practice for a board to have this kind of review every once in a while. So we hope that this will be useful. Starting out with the most basic thing, what is a fiduciary? It's a person in a special relationship of trust and confidence and responsibility to others. When we say trustees, as Wanhong mentioned, we mean the board members and commissioners. It's the members of the governing body that have that both, of the fund that both receives pension contributions and then funds pension benefits. So it's, even though you're not part of a decision-making process for the pension side, you are tied to the pension beneficiaries as in your fiduciary relationship. RSIC itself is a fiduciary. We understand that you contribute over 50% of the income that pays for the pension benefits of the 5 state defined benefit plans. And you have exclusive authority for investing these assets in trust for these beneficiaries. And that, you obviously as individual members are fiduciaries that have the responsibility for carrying out what RSIC as a board, or as a commission, I should say, it has to do. You owe fiduciary duties to the entire organization, not to any limited part of it. But again, your structure makes it a little more straightforward than many organizations have. Next slide, please. So what are the fiduciary duties? The universal concepts that you probably are familiar with are the duty of loyalty and the duty of care. There are additional concepts that are derived from various sources, such as ERISA, which the employee retirement retirement. I'm sorry, the Employee Retirement Income Security Act of 1974. We'll mention that a few times, and just to clarify, as you I'm sure know, RSIC, or your pension plan more appropriately, is not subject to ERISA, but it is something that we'll look at, and we'll mention this a little bit further down. Anyway, additional sources may lead, there also may be state law sources and so on, and they may lead to a discussion of the duty of obedience, the duty to diversify investments, and the duty to use plan assets only for reasonable expenses. You have a very convenient governance policy manual that in part 1, and especially the parts noted here, G, H, and I, lay out a lot of what your fiduciary duties are, or how you can think of what your duties are when you're considering fiduciary duties. And that's something we would suggest that you have handy, because it could be very useful. But basically, just to finish this slide, fiduciary duties boil down to variations on the duty of loyalty and the duty of care. And next slide, please. So to talk about the duty of loyalty, this is obviously because the people that have contributed to the plan, both the employers and the employees, and the people who will benefit from the plan, have entrusted the commissioners, with what is essentially their money, as they may view it, and their future retirement income, and they expect you to take care of it for them. So this means you must act in the best interest of RSIC. You must not place your own interests ahead of the organization's interest. You have to put aside other interests, such as those arising from personal relationships, family members, friends, colleagues, and your day job. Even board members that are appointed ex officio or based on their connection to a particular organization that is linked in some fashion to the plan. Their job is to serve the whole organization, not their employer. And the key that we'll spend more time talking about is that you must avoid actual, potential, and apparent conflicts of interest. And apparent is probably the most important one to think about. You always must wear your trustee hat and consider what's in the best interest of RSIC. And now we'll turn it to Andrew. And sorry for the challenging pronunciation, but it is Andrew Foyt, as Juan Han said. Go ahead, Andrew. And next slide.
Good morning. Yes, next slide. Good morning, folks. So as Margaret just mentioned, the conflicts of interest is really kind of the first big stop in kind of this assessment of the duty of loyalty. And so much of this comes down to really ensuring that there's full and complete confidence in the system, in the decision-making process. And as soon as conflicts of interest start to creep into a system, you lose that credibility and that confidence, and there's a tremendous amount of difficulties that come after that. So we list here, I mean, certainly actual conflicts of interest are the most straightforward, but at the same time, I would say it's still a little shocking how often they do come up and they're revealed to actually happen, and they're a bit shocking. I think it's maybe somewhat easy to skip over that because it's so obvious, but at the same time they keep occurring and create a lot of difficulties. The potential conflicts of interest are really along the same vein. They could present potential conflicts, and so they should be carefully monitored. The last category here, as far as the appearance of conflicts, this is, I mean, without a doubt, the most tricky, and unfortunately, it does create a lot of kind of additional work, and a lot of attention should be paid to the appearance of conflicts just to keep everything clean in the system. And it's unfortunate, but at times of crisis and difficulty, it's easy to kind of look back and start to unwind things and really kind of reveal that there are situations that were involved that really might have compromised the decision-making process or influenced the decision maker. So we will spend a fair bit of time on these types of items. Next slide, please. The big thing here is maybe stepping back in kind of the situation to really kind of assess how others might view a potential decision and how various facts may come into play, and really kind of look at it from that outsider point of view, so as to maybe kind of see it in a different light. And a lot of times, I mean, it can be quite difficult to really kind of parse out all of the various kind of aspects that might come into play and be viewed as potentially conflicted, but there's a lot of benefit for doing that, because as a system, you don't want your objectivity or kind of the validity of your decision-making process to be questioned. Next slide, please.
And it's back to me, I think.
Yeah.
Are we on? Yes. Thank you. So for RSIC, I think we need the next slide. It's not going to number 9.
No, I see it correctly, Margaret.
Oh, I think I have a delayed reaction because it did not switch as quickly. Well, if you're all looking at the right one, I have it in my hands as well. So if we're on slide 9, the separation of your pension plan from the investment commission eliminates a lot of the issues about conflicts of interest. So this actually should be a really quick slide. There's a number of situations that many other similar organizations would face that you don't, because of your structure. A lot of times when there's a combined pension and an investment program in one organization, there could be problems when trustees are pension beneficiaries, and they may have made a decision that would benefit themselves directly. There was a major problem with San Diego City Employees Retirement System about some years back, about a decade ago, I think, that where there were lots of things that went awry, but one of the main things that really stuck in people's minds was that the trustees took action that increased their own pensions to the detriment of the pension system. And as you know, there are other situations like that, as I said, that don't affect you, and let's just view that as we're mentioning this so that you can see how maybe compatriots across the country that work with other systems may have these kinds of concerns. It's something to be aware of, but it's also just to give you a flavor of the types of things that could be conflicts. Next slide, please. And I'm still seeing 8, so I'm hoping that you're all seeing 10. The investment conflicts can arise in the structure that RSIC has. We understand that you've delegated investment decision making primarily to the investment staff, the professional staff, which we think is consistent with the duty of care. But the delegation doesn't mean that you won't see conflicts arising in the role that you do have with asset allocation, for example, and even the approval of particular new categories of investment, for example. I think in each of these cases, a trustee could have a financial interest in one of the categories that the organization is considering pursuing, that it is new, or it may be considering increasing an allocation to, and that could be seen again as an apparent conflict of interest, as something that would undermine the confidence in the decision that that new allocation arrangement or new investment type is appropriate for the fund. Next slide. And in short, actual conflicts relating to investments, as well as the appearance of conflicts, can arise for any institutional investor. Particular scenarios that RSIC might face are, a family member or friend working for a firm that's providing services or offering or seeking an investment from RSIC. A former RSIC employee now works for a manager that's seeking an investment. Here, there are state ethics laws and policy requirements that impose limits, but at a certain point, those limits no longer apply, and there still can be an appearance of partiality to a former colleague or a former staff member. That is just something to, as Andrew was mentioning, to be aware of, that you may have to make sure that when you're evaluating somebody that does have a connection, that you've taken whatever appropriate steps you can take to minimize the concerns that might arise because of the appearance of a conflict. Even if a board does all the right things, which we'll talk about some suggestions in the next slides, the appearance of a conflict, may be ultimately the problem, because it means an appearance of unfairness, which can lead to distrust of the system. Next slide. So how do you deal with conflicts? The standard answer is you want to, first of all, to disclose them and make sure that they're known when they are there as opposed to hidden. The standard idea is that you want to avoid conflicts of interest, but conflicts may simply be unavoidable because relationships do exist. So they especially may be unavoidable when trustees need to be people that understand the job they're undertaking. They may have those connections in the industry, the relevant industries. So disclosure is the first step. State ethics laws again come into play in covering what must be disclosed, but trustees have, should exercise their own fiduciary duty of loyalty and be mindful of conflicts that may arise, that may or may not be clearly required to be disclosed under the ethics laws, and therefore they should take initiative to disclose them. And bottom line is, when in doubt, disclose. But again, even if the relationship is disclosed, the appearance of a conflict may be a problem. The appearance carries the potential for undermining the related decision-making process, and it can lead to legal and maybe even more importantly, reputational scrutiny to the same extent as if you had an actual conflict of interest. Next slide. So how do you, another question of after disclosure, how do you deal with conflicts? And I hope we're on slide 13 at this point. Yeah. How do you deal with conflicts after you've made a disclosure? Disclosure is necessary, but not sufficient. The applicable law may actually prohibit the transaction, and here again, the governance policy manual provides a very convenient list of the conflicted actions that are prohibited. This also includes references to South Carolina laws that are relevant. So again, it's, as I said, a very good resource. If it's not prohibited per se, there still are possibilities of ways to minimize the problems from the actual or potential or apparent conflict. And that's recusing and abstaining. I actually looked up the word recusal yesterday because I wanted to understand whether it's different than abstaining. And it has a concept of disqualifying oneself and removing oneself from participation. So it's broader than abstaining or not voting. In other words, preferably if you have a conflict, you should not be part of the evaluation, discussion, or vote. And this can sometimes lead to, it seems to be maybe counterintuitive that if an interested trustee is very knowledgeable about a situation, that they should be involved in the evaluation and discussion. I think you have to evaluate that scenario whenever it comes up and decide what's most appropriate. But in any case, the interested trustee should not be part of the vote. And, after giving the information that he or she has, may be best to just, separate and not participate in the further discussion. One way, even if you have a recusal and abstaining, one way is that to further sort of help the situation of a potential conflict or an apparent conflict is to counteract it with the appearance, with the use of a third-party independent advisor that can help validate the decision. Somebody who has no interest other than providing appropriate advice can help determine whether whatever the interested trustee might have, whether the interest of the interested trustee might have suggested was a conflict. The independent advisor can help evaluate and give guidance as to whether there's any, whether the decision would be a good one or not. Next slide, please, and turn it over to Andrew at this point.
Another prong of the fiduciary duties is really the duty of care, and so we'll spend a few minutes on this concept. And really kind of the classic description of the duty of care is the prudent person concept, and that's listed there in the first sub-bullet point, that it's really kind of applying the care and skill and diligence of an ordinary prudent person, and how that would be applied in a circumstance or applied by another person in a like position. And really what that boils down to is making sure that there's a proper application of good sound judgment by competent individuals. And really the way that the commission is set up is there is a qualification standard that is pretty high. I mean, we've seen a lot of different boards and commissions, and what's required here is pretty high. And what that means is that in making decisions and implementing procedures and policies of the board, that expertise is brought to bear for the benefit of the system. And so really they're going to look to that level versus kind of another financial professional, but with only a year of experience. I mean, that's much different than your qualification standards. So kind of getting back to it, you do have to bring to bear your expertise and apply that in an appropriate fashion for the benefit of the system. Next slide, please. And really kind of what does that mean? I mean, it can kind of be borne out in a number of different ways, but certainly first and foremost is being well prepared for your role as a commissioner for the system. And that means doing such things as be competent, be well informed of the current market, do your homework, ask a lot of questions about kind of where things are headed with the system, why things are being done, reaching out to experts when you feel more expertise is needed or additional information is warranted. I mean, and then kind of at the end of the day, it falls to you to make sure that you kind of take that all in, apply your expertise, and make a good independent determination of the direction for the system. Next slide, please.
And that's back to me. So we wanted to jump from that idea about exercising your independent judgment and talk a bit about how you do that when you're also when you need to and you're entitled to delegate certain decisions and rely and engage experts to assist you in your role. And how does that play with independent judgment that you must exercise? Well, the scope of your decision making is unique to every organization, so there's no one size fits all. In my own experience on boards, I think one of the big challenges is to understand the line between where the board or the trustee group, the commission, where what it is supposed to do, what the trustees are supposed to do versus what the staff is supposed to do. And the staff works full time and they are specialists in what they do. The board members only serve part-time. Usually they have other jobs. And as Andrew was just mentioning, you have a high level of knowledge and experience in the relevant issues for an investment commission, but you may not be experts in all of the issues of the organization. So you have to delegate to others, and every organization has a line about where they draw that delegation. The general rules of thumb are that board members may rely on information from experts and advice from others that are, so long as they're qualified to give that information and advice. So obviously that would include staff and investment advisors, such as where you were just having a presentation from, attorneys, accountants, and others, and as well as board committees. And you're a relatively small board, so it may not be, I'm sorry, I don't know whether you have any board committees, but it is, often there are standing committees such as audit and so on, audit and governance, but you may also find occasions to form an ad hoc committee to address certain issues that come up, and that provides a smaller group of the board members that can devote additional time and may be selected because of their particular backgrounds to study a particular issue, and then they can advise the board as a whole. In any case, a board should rely on others when expertise is required that they do not, the board members themselves do not have and are not expected to have. And as mentioned earlier, looking to independent advisors also provides some support to the idea that you are you're avoiding conflicts of interest, or you're addressing them in an appropriate manner, and as well as supporting your exercise of the duty of care. But when you do engage experts, when you do rely on your staff and others, you need to, of course, select them with appropriate level of care and then monitor them. You have to pay attention and make sure that you're choosing people that have the appropriate qualifications, and then exercise that independent judgment to say, does it make sense what they're telling us as you go forward? Next slide, please. So process is the key. Process and documentation actually are very important in all aspects of fiduciary duties, and certainly in the duty of care, there's a concept of prudent process, and documenting the process is a way of again, showing that you are exercising your fiduciary duties appropriately. So you should have a process for making investment decisions, which you do, and then you should follow that process in every case. Making a decision without going through the normal steps of your review and approval and so on is, it just leads to the potential for a claim of breach of fiduciary duty if that particular investment goes awry. You should also periodically review whether your process is a good one, and I suppose fiduciary training is part of that. But more importantly, I think it's looking at doing a self-evaluation of the overall activities of the board, and looking for advice on what is best practices, and then as and when appropriate, making changes. Having a responsible process and showing that you've used it are important ways to minimize the risk of claims of breach of fiduciary duty. Next slide. So a few other fiduciary duties that are sometimes mentioned. Duty of obedience is, as suggested earlier, this might be, some people might ask, is this really just a part of the duty of care? But in any event, it's often reflected separately as a fiduciary duty, duty to comply with the governing statutes and the laws. There's also, as mentioned earlier, ERISA does not apply to you, but it is generally considered to be best practices for how a pension system works, and that includes the investment process that is undertaken by the pension system. And therefore, ERISA may come into play if you ever have questions arise in any kind of a claim. But we would assume that you look to Betsy Byrne and her team to make sure that you are complying with laws. And again, you've got that very handy governance manual. Next slide. And this back to Andrew.
Yes. So really, this slide is entitled "Other Fiduciary Duties." I view this concept of diversification of assets is really kind of an obligation, perhaps that flows out of the fiduciary duties. In that, ensuring that you apply that prudent person standard and your expertise, it's commonly recognized that a good diversity of assets is a required concept. And just listening in on the Makita presentation, I mean, it's obvious to me that is something that you're well aware of. And just ensuring that your decision making with respect to the allocation is based on sound portfolio management principles. And certainly the last item here was around, does this argue against divestment? And there are a lot of very good arguments that if you have really settled your portfolio allocation based on sound portfolio management principles, then a sudden cry for divestment due to some recent event or something may really be against what's best for the system in the long term, looking at really the way investment returns are expected. So I think that you have this concept well covered. So we'll go to the next slide.
Can I actually pause you there and ask a question real quickly? And maybe
Absolutely.
I'll touch on this later, just because there's been some news on it recently. I'm not as familiar with it. Under the prior administration, and under UN guidance and under the Obama administration, they tried to create more of a pathway, around ESG related items, right? And the current administration, I know, has rolled some things back. I don't really know, are these rules, are these legislation? Like, A, what's the actual legal status of what's sort of being talked about? And then B, sort of what's the current actual status? Did I make that question clear? Like, is it regulatory guidance or is it actually law? Is it an executive order? Like, what's sort of the nature of, what we're sort of tangentially reading about in some of the magazines?
Margaret, are you aware of the of kind of the basis there?
Well, I confess that I think our colleagues who are ERISA attorneys would have some, they themselves say that, exactly what's required at this point is still a little unclear. But I believe that this is DOL has made statements. Now, again, we should repeat that since RSIC and your pension plan are not subject to ERISA, you are not under those laws at all, but ERISA does provide guidance. And I think in general, the question of whether a pension fund should consider ESG is a live question. It's out there. And we actually had thought about addressing it, but we understand that you have some particular legislation in place that is provides you some particular guidance on this. But in general, if so first of all, whatever DOL has said does not directly apply to you, but they are saying that they're rolling back somewhat this sense that it may be a fiduciary duty to consider ESG considerations as you make your investment decisions. Now, I think there's a much needed refinement of this whole discussion, and that if you think about, as you were talking earlier, about the long-term nature of your investment program, if you think about the long-term nature of your investment program, you have to realize that it's something that is going to sustain over a long period of time. Is, factors that go to sustainability are important. And therefore, environmental, social, governance factors may well be critical to the overall evaluation of any investment decision. But that is something completely different than saying, oh, we would really like to invest in improving low-income housing in South Carolina, and we want to invest in local businesses because that's good for the economy, and other decisions of that sort that are more in the range of impact investing. I think there's still a pretty clear line that impact investing for its own sake is not appropriate for pension funds. The question has come down to, can you, DOL's view used to be all things being equal, you can take it, all other things being equal, you can consider impact or social responsibility or environmental social factors and so on, all things being equal. I think all of us would have to agree that there's never all things equal in two different investment alternatives, right? So that's a rather difficult standard to work with. But
Can I jump in there real quick?
Yeah.
Because the standard that you cite, the one that's is difficult that is exactly the standard that is in our statutory guidance. So it's it's all things being equal. Ultimately we have to judge the merits of the investment solely on the merits of the investment, and we can take secondary considerations into account, all things being equal. So so that is the standard by which we live by. And Alan, we run into this a lot. When we go to conferences, there's a huge, obviously, ESG push in the pension community, but it's not something that at this point I don't think we would even be statutorily permitted to take into consideration as a primary reason to invest. So.
Yeah, and I think the main thing is that at some point, given there's a couple of things happening. One is that in Europe in particular, there's a very big push for European institutional investors to consider ESG factors as a requirement of their fiduciary responsibility. Does that lead to, when you look at fiduciary duty of care as what an ordinarily prudent person would do in similar circumstances in a like position? Well, if all of the Europeans in a similar situation as you are taking into consideration these factors, are we at some point going to trend toward that being a requirement for anybody else in a similar situation? I don't think we're there yet, but it is something to sort of keep mind on. But I guess the other thing is, again, to differentiate between sort of impact investing and sustainability and good due diligence on investment programs. And if it's important to consider whether, there's going to be an environmental calamity from an investment, and that's going to make it a worse investment, then of course you have to consider environmental factors. But it's not, and I think that sometimes people don't sort of realize that integration of ESG into due diligence is perhaps not merely appropriate, but it may be, in essence required for any good due diligence process. But people have, in the current environment, been sort of putting a label on it. We've seen all kinds of managers say, oh yeah, we're going to hire our ESG expert, and then we're going to charge that to the fund. I mean, they're sort of putting it as a separate set of considerations. But I think it can be a direct part of your investment evaluation from the long-term perspective.
Right. Take those into consideration and start working them into your portfolio decision-making process. But like I said, just doing it for ESG purposes is generally viewed as something that's not required.
Yeah, and not appropriate. And and I think, as you've said, your job is to provide funding for the pension benefits. It's not to have any impact on the rest of the world. I wish we could give you a real, cut and dried answer, but I think this is an area that's in evolution, and your law, saying all things being equal doesn't make it easy to, it doesn't make it easy to say you want to choose, how are you going to find an investment in South Carolina versus one in California that does similar things? I don't know. Maybe there's a situation where you'd have the all things being equal scenario, but it does make it very difficult to apply that in any useful way.
Any
And
further questions there?
No, that was helpful. I was kind of curious. So it's more just sort of regulatory guidance statements at this point. But part of what was driving the question is you're seeing more and more companies starting to, lawyers are making them put them in their 10Ks and Qs, and insurance companies are starting to identify it in policies. And it's starting to creep in,
right.
you know, at a corporate level. You know, I don't know at a portfolio management level where we tend to talk, it hadn't crept in, but you're definitely seeing it creep into financial statements, right?
Right. Yeah. And as I mentioned, I mean, we're seeing it as a cost that you as an investor bear for a, you know, a private equity fund that you're investing in. Mm-hmm. You know, there's an ESG consultant cost that, you know, who knows? Okay. So we
right. So starting with the next slide, slide 20 there. Just that, no, yeah, there we go. Still 20. The point here is really, again, an obligation flowing from your fiduciary duties is really to ensure that the costs and expenses of the plan are appropriate based on what needs to be done. And I mean, we understand here, yes, that RSIC is not responsible for benefit administration, but there is still the costs that go ahead along with ensuring, you know, proper staff and trustees and overhead, and this can be a bit of a sticky spot. I mean, there's no getting around it in that. I mean, you do have to limit your budgets, but you do also have to make sure that you have adequate personnel in place to properly administer the investment program. So, you know, that is something to take into consideration. And then really a step beyond that is looking to see what fees are paid to managers and ensuring that you are properly compensating your managers, but not overly compensating them. And so there's a lot of balancing there. But it is generally viewed as something that based on your duties, you do have to really kind of keep an eye on. And the last bullet point really gets to kind of ensuring that there's proper transparency to the public and you know, giving confidence that there is proper you know, budgetary restraints, but then also ensuring that you do have confidentiality around key concepts for, you know, kind of employment, engagements, et cetera, and personal information. So there again, this is just another extension of some of those duties that come out of your you know, kind of duty of care. So next slide, please. And that's back to Margaret.
Yep. So do pension boards actually get sued? The answer is yes, and fiduciary duties are usually part of the claim. The claims, you know, one of our litigator colleagues who has worked on claims in the investment world says that basically claims always come down to a breach of fiduciary duty. And it's mainly because in the investment space, frequently the specific tasks of managers in particular are not laid out in a way that shows, you know, where you can bring a claim of breach of contract or violation of law that applies. So breach of fiduciary duty is often what you see in claims involving managers, and that sort of bounces up to the level of the investors or the decision makers who make investments with managers, is whether they too have met their fiduciary duties. So these claims can include, you know, the organization that manages the investment, the board or commission, which would be RSIC, and then individual trustees can also be brought into claims. The key is that the claim, you know, wherever the claim is directed, whether it's the board or organization or individual trustees at all, you know, it's the same basic set of allegations that somebody wasn't doing what they were supposed to be doing. So that's why we look at claims against institutions when we're talking about fiduciary duties of trustees. Next slide. So this is another quick slide that we'll go over. There are a lot of claims that you see out there are ones that don't apply to you because you don't manage the pension system and you don't have a defined contribution plan. Those are a lot of claims that come up in that context and other claims that come up in the space context of benefits, we'll just, again, say, you don't have to worry about that, which is a good thing. So next slide. Again, just showed that for flavor. But there are circumstances where you may be sued for breach of fiduciary duty related to investment decisions. And, basically it happens when the investments go bad. If investment's doing well, nobody's going to worry about whether there was a conflict of interest. They're very unlikely to worry about it. So the claims of breach of fiduciary can relate to, lack of due care in an investment decision. If you don't know enough about the underlying investments, that you can't see what they are, they're not independently verifiable, or maybe even that the board, the decision maker, didn't fully understand the true nature of the investment program and thus didn't understand the level of risk involved. There could be claims of lack of due care in monitoring these kinds of investments, especially if there's, low visibility or transparency into the investment underlying assets. And then the appearance of conflicts of interest in selecting a manager that has a minimal track record. For example, in particular, if there's a problem with the investment, was this manager hired because it was connected to somebody on the decision-making body. So on to Andrew again.
Yeah. So just
Next
generally
slide.
speaking, are we okay on time? I think we might be up against the time limit that we were given. So I want to make sure that we can keep going and be mindful of your time.
Yeah, I think, if we can kind of wrap it up in a reasonable amount of time.
We're
Okay.
close to the end.
Yeah, we're pretty close. So, the last point that Margaret made around the appearance of conflicts of interest, and I spoke about that earlier. I mean, I can speak to situations where we've seen some bad investments, right? And in one case in particular, there were some questions that arose years after an investment was made, and one of the things that came back to me was really kind of the way that it was handled internally. And I remember I was a pretty young attorney at the time, and the CIO of this state plan was calling me up to make sure that his deal got done, and I took really good care of him, and set up the deal. Just it was a series of platform investments, so it really kind of was along the lines of the platform, but the CIO was engaged, and at the time I thought that was really neat. Years later, the system called me up and asked me about that investment, and it kind of was no surprise that investment came up because of the way it was handled internally, and then there were various conflicts of interest that started to be revealed in that process. And the next slide kind of is more of the same in some regards, and that kind of looking at the Kentucky, I'm still on 24, but the Kentucky situation is a bit unfortunate, and again, it's really bad investment result concepts that then lead to a lot of second guessing around what happened at the system. And I'm not sure if you all are aware of those facts. There are key items highlighted here. A lot of allegations involved in that claim really look to really that duty of care, right? That we spoke of earlier, and just kind of that obligation of being fully engaged, and as a prudent person, being inquisitive around what is happening with the portfolio, being sure that you're asking questions around things that are happening in the plan that don't seem to add up over time. And certainly this case involves serious allegations around improper actuarial assumptions that time and again proved to not be on point, yet they stuck with the assumption of 7.75% returns even when they had negative years. And so there are those things that really kind of come up, and the system is going to be questioned around, was that a proper application of the duty of care? And unfortunately, too, you do have a lot of people asking questions around red flags. Why were you investing heavily in hedge funds? And certainly we know about Madoff and other scandals in the industry that involve managers in that space, and criticism of why managers would get paid the exorbitant fees that they do, and the profit share that they obtain. And those, you can look at the reality that managers do get paid and compensated for providing adequate and good returns for a system, but that all falls into question once problems start to develop. Next slide, please.
And I'll just chime in on that red flags point. I thought when I saw that being mentioned in the Kentucky case that it seems a little unfair to say, well, you should have known these investments would go bad because of Madoff. But I think it's, the point is that everybody is now on, should be on, have heightened awareness that, when you don't know what's going on under the covers, you need to open it up and see what's going on inside the box.
Yeah. So kind of this next slide is really, pulling your attention. I mean, once you start to understand that you have some problem investments in your portfolio, kind of making sure that you start to kind of understand what that means, and a little bit here deals with, I heard Makita talk about the chasing returns, and if the plan starts to run into shortfalls and those actuarial assumptions are not playing out, then there is a little bit of a concern that a plan would go ahead and start chasing returns in order to kind of get back on level with their funding assumptions. So you do have to be aware that will be something that can be questioned if you've changed your allocation to various asset classes. Maybe just a couple of things here to note also is that really your process is important here. So you can be on top of claims of manager misconduct and be aware of what's going on. Most importantly, before you go into an investment, and if you are an investment, becoming aware of that as soon as possible and being able to be proactive as possible. There is kind of this bullet point around manager misconduct, and again, the problem investment that I mentioned earlier really became known because of a good process within the system. They looked at how the $100 million investment had been made, what it was invested in, what was happening with the portfolio. They then started to ask questions of the manager around what was going on. One of we wrote here in a bullet, failure to follow investment guidelines. And one of the first things that happened with that fund was a request to waive the single investment limit, and they invested 50% of the fund in a single asset and then didn't do anything else for years. So staff started to raise questions around why that investment was made and how it was being handled. And then they were able to kind of track back on it. And eventually, because of a good process, I would say that they got on top of the asset before further damage was done. And actually, it was kind of a neutral result for the system as far as kind of how the asset the investment played out. But those are the things that can start to happen. Let's jump to the next slide, please. I think there, maybe things to hit on quick here, as far as making sure that you have a culture of allowing staff to go ahead and inform the board, or have a good chain of command. Fortunately, in the bad investment scenario I was just speaking of, the CIO had to move on, and then they were able to more kind of be more honest with their team about what had happened a bit, and so it allowed the system to correct the situation, but making sure that you have a good open avenue for ensuring that there is dialogue around things, and really kind of more in the open, the better, right? So things to just watch for are these red flags, things around reporting becoming less timely, less complete. You're asking the manager to complete things, and you're being told that you'll get that right away, and then you don't hear from them for months on end. They won't return your calls, et cetera. I mean, those are things that they happen in maybe one or two instances. It seems a little innocuous, but that's the way. It's like the first sign of things starting to go really wrong. So, being on top of that, being aware of those things are really important. So maybe it's back. We'll go to the next slide, and it's back to Margaret for a few more items, and then we can open up for questions.
We're almost done here. So, Andrew just talked about what a board can do to try to avoid or anticipate problems. And this slide is really what do you do once there is a problem? And your duty of care says you need to protect the interests of the fund. Obviously, one of our ERISA colleagues says that the duty of prudence means that a pension board should pursue claims that the plan may have, of course, depending on the overall economics of the situation. But the point is that the claims are assets of the pension fund that should be preserved. So you do, sort of think about having to follow up on problem investments and enter into litigation if necessary. But you start by getting all the facts, and again, good communication with your staff is critical, and you have to trust your staff to give you what you need, and then evaluating your options. If you're dealing with a fund that is doing bad things, and suing the fund, of course, is not going to, may not be fruitful, because it's in effect suing yourself, but and often the fund manager may not be a deep pocket. So unlike the Kentucky case, fortunately, the managers involved there were big name managers with big institutions, and they are deep pockets. So, there's something to go after there. There's a reference here to a board memo, which is not a term of legalese. It's not a defined term in any way, but it's just a concept that getting a formal memorandum of advice from counsel can provide a way to evaluate a situation without public scrutiny, because the memo can be privileged and not subject to public disclosure. Again, forming a committee, as mentioned earlier, may be a way to sort of get on top of what a problem investment may turn out to be, and then collaborating with others. And I should, of course, be responsible here and remind you that you need to consider the investment documents that probably have, or almost invariably have, restrictions on disclosure of confidential information about the investment. But within those bounds, it's important to collaborate with other investors. And of course, don't wait. According to our litigator colleagues, whenever they talk about problem investments, they say don't wait, get moving, get on it, before it gets worse. Next slide, and I think this is our last slide. We just wanted to briefly mention that we and your investment staff and your investment internal counsel spend a lot of time talking about fiduciary duties of managers, and we included this because as we mentioned in the may not be able to hear your speaker because my volume is too low. I hope you can hear me. As Andrew mentioned, in the Kentucky case, the managers were alleged to breach fiduciary duties along with the trustees. Unfortunately, manager fiduciary duties may be more limited than you would wish, that you would think. The language in most private funds and in many separate account agreements also seek to minimize the manager's fiduciary duties. It's all on an argument we don't want to be second guessed and so on. You can look to ERISA here. Most separate account managers for ERISA are ERISA fiduciaries, and fund managers typically are not, but they do have fiduciary duties even if they're not ERISA fiduciaries. ERISA fiduciary standards have additional requirements that are technical conflict of interest processes and so on. But again, they are, just as a guide to think about whether somebody is a fiduciary under ERISA, ideally you'd like to get the same kind of basic fiduciary concepts of duty of care and duty of loyalty from your managers. The key point is that it's not enough to pass down the fiduciary duties to the managers, but that could be a whole session on its own. So we'll stop here, and if you have questions, we're happy to answer them. We know your schedule is tight, so also happy to let you to your next project.
Mr. Chairman, Mike, just first of all, just wanted to apologize. I lumped. Yeah, this is Mike Hitchcock. Mr. Chairman, first of all, I want to apologize. I lumped K&L Gates in with our Securities Litigation Counsel, and of course, that's not what they do. They are our investment counsel, so they are the ones who sit across the table I did get a note saying my speaker volume is low, so I hope I'm not missing anybody making comments. Okay. So they're the ones who sit across the table from our GPs and try the best that they can to make sure that we're not beat into submission. So and they do a fantastic job for us. But one of the things that I wanted to do is I think they brought up a lot of good points about things that we should be looking at and how we should be carrying out our fiduciary duty. I just wanted to make sure that some of those points connected back to how we address those, most notably with, we spent some time talking about conflicts of interest, and, that we do have a very vigorous process by which we attempt to manage and avoid conflicts of interest. As all of you all know, as commissioners, you annually file material interest statements. We also do a sourcing and conflicts disclosure declaration for every investment, which encompasses, and this has become certainly more relevant during with the delegation policy, where everyone who's involved with the deal team of a particular investment, along with Jeff and I, have to. And if we bring those to the commission, then the commission has to sign those, indicating how that the investments were sourced and that there's no conflict. We also have a vigorous internal trading policy. We have a restricted list and a watch list to make sure that we're avoiding potential conflicts of interest there. I think everybody's, when it comes to processes and procedures, we have a very vigorous investment due diligence as well as operational due diligence policies and ongoing due diligence manager monitoring to make sure that not only are we trying to flag problems with managers on the front end, but also on a go-forward basis if any of those problems arise, and that once every 4 years we have an outside firm come in and do a fiduciary audit to pass judgment and to give us a thoughts on how we can improve our practice in those areas, and also that those processes are also subject to our annual agreed upon procedures to be tested as well. So there's a lot that I think that they did K&L Gates did a great job of highlighting, and I think that when I look at what the problems with exercising fiduciary duty that they've highlighted, I think we do a very good job of ensuring that we're complying with and addressing those potential issues. So just wanted to make that statement.
Thank you, Mike. Do we have any other questions or comments for the folks from K&L Gates?
Yes, Mr. Chairman, this is Bill Condon. I have 2 questions.
Go ahead, please, sir.
The first is, one of the first few slides in this deck said that the trustees have a duty to RSIC, duty of loyalty to RSIC. several times, it just mentioned RSIC, but doesn't our duty extend beyond just RSIC as a separate agency or a group of people? I think we got to have a duty to other fiduciaries like PEBA, and also as South Carolina state law says, we have a fiduciary duty to the plan itself, the plan beneficiaries, and the plan participants.
Yeah.
So I just want to confirm that our duty goes beyond just the duty to RSIC.
Bill, that's a great point. This is Mike. You know, the commission, along with PEBA's board, are co-trustees of the trust, right? So, you know, you along with the PEBA board serve as trustees of the trust. So you're right. The fiduciary duty is not just to RSIC as an organization, it's really to the trust itself. So, you know, by serving on the commission as a body, you know, you have both, I believe, an individual and collective responsibility to the trust. And state law also lays out specific name fiduciaries to the trust, of which all the commissioners are. I am, Jeff is, we're all named fiduciaries. And I see that fiduciary duty really extending not just to the more importantly, not necessarily just to the organization, but to the trust itself.
Yes. Yeah. Thank you, Mike. I thought that was the answer. Looking at that slide alone might be a little misleading. So I just wanted to confirm that.
Yeah. Even though you're called a commissioner, you really are a trustee.
Yes.
Yeah.
Yep. The second question, and I'd like to get K&L Gates' opinion on this, is you know, of course, we've got another player as well, and I don't think they're defined as a fiduciary, but the General Assembly, who sets the assumed rate of return with some input from PEBA, and then we get some input into what PEBA tells them, I think, to kind of broadly say it. But the General Assembly basically sets the assumed rate of return. In the slide about obedience, it said we should follow statutes. So I'm wondering what K&L Gates thinks about, do we have a strict duty to have an asset allocation that matches, that tries to make a return of the assumed rate of return? Or should we experience, which I think is more likely, or exercise our own judgment and come up with an asset allocation that if we feel 7.5% is too risky, that we might approve something less?
That is not an easy question. Oops. Sorry.
Can you hear me?
Can you hear me?
You're
yes.
Yeah.
I think I was can you hear me now as well?
Yes.
Yes.
Okay, thank you. I'm phoned in and I didn't want to, anyway, sorry. This is Margaret. I wish it were an easy answer. I guess I think your decision is, your program has to take the long-term perspective and also take into consideration what the actual opportunities are. And if your assessment is that designing something that would potentially get you the return, but at a risk level that is too great, I think you have to consider the full aspects and whether something is likely to be sustainable over the long-term horizon that you should be thinking of. So this is probably a wishy-washy answer, but I think you have to make investment decisions or allocation decisions based on what's realistically attainable within the risk level that you're comfortable with. I think you cannot say, well, they may tell us we're supposed to return this amount, but we don't think that's obtainable. Then, you should not be creating a program that in the short term may, satisfy that requirement in theory, but as a practical matter, will not be sustainable. I guess I would say, you know, that's not, I don't think you need to do that. I mean, I'm very hesitant to give you an answer on this question. I think if I understand what you're saying that they prescribe what they think should be your rate of return, but that's what they use in setting sort of how well funded the plan is and that sort of thing. If they're telling you that should be your investment target, then I think you have to comply with that. But if they're using it in a different way, then as a guide for how the overall program is to be operating, including what is contributed from managers, from employers and you know, all aspects of the economics of the system, you know, if it's one factor, I don't know that it is telling you what you should do in terms of your investment program.
Bill, if you don't mind me, you know, I still play a lawyer on TV every once in a while. If you don't mind me taking a crack at that, you know,
sure.
Yeah. This is how I kind of view it. You know, the assumed rate of return is set by statute, and now there's a process by which it'll be reviewed every 4 years, and ultimately there will be a recommendation by PIBA with, you know, taking into consideration our point of view as well as the actuaries as to what a reasonable rate of return is. You know, I think where our job is, you know, certainly on the front end of that, I think, you know, collaborating with PIBA being our co-trustee to give them a good sense of what we think is attainable with a reasonable degree of risk. You know, that duty is pretty easy and set out and pretty straightforward. But I think that, you know, we also have to take into consideration, you know, we also, I think, ultimately have a duty to, you know, if we don't think that is attainable within a reasonable degree of risk, and if you kind of overlay on top of that the 70% risk, the 70% limit that we have the public equity, right? You know, if we feel like that earning any assumed rate of return over a period of time will require us to take more than, to a certain extent, is the governor or the speed limit of risk that we're allowed to statutorily take. You know, I think that we have a duty at that point to communicate to, you know, to PIBA and to the General Assembly that concern and that problem, and, you know, and ultimately react accordingly. Because I don't know if by law, you know, the way that I read the intent of that limitation is if we can have a portfolio that would have more than 70% of its, you know, 70% risk coming from an allocation to equities. So, you know, that's the way that I look at it. I think that there's a duty to communicate and collaborate, and that, you know, at some point that 70, we always got to take into consideration that there is a risk limit that's out there.
Yeah, I agree. Good points.
Yeah.
And thank you, K&L.
Yeah, absolutely.
Well,
yeah, just one last final thing there is, I mean, again and again, when you look at claims and systems that get into trouble, the problem a lot of times is getting behind on what the assumed rate should be, and then having to try to catch up by chasing returns, and then you run into problems. So being really good about that upfront, you know, kind of input to the rate of return that's expected would be helpful for making sure that you don't later get that pressure to try to catch up and then take on an unacceptable level of risk.
Okay, anyone else have questions or comments for the K&L Gates folks? All right, if not, moving on, going to ask for a delegated investment report from Mr. Berg. Go ahead, Jeff.
That's it.
Thank you, Mr. Chairman. Just in order to comply with the delegation policy, we provide the list that you can hopefully see on your screens right now. We did close 5 investments between meetings. They are on the screen. We, as is our practice, we have provided the summaries to you during the closing process, and I don't want to take 20 minutes and walk through all of them, but I'm happy to, Steve and I are happy to answer any questions if there are any.
Jeff, this is Bill. I have one question, and it's the last one on the list there, the Nordic Capital 10. It's a investment of up to 100 million euros. What's a 2-minute synopsis of what that is?
Steve, I'll defer to Steve. It's European private equity, but I'll defer to Steve for a more nuanced explanation of that. Steve?
Hey, can everybody hear me?
Yes.
Great. So I think really quickly, just on the top down of why we're attracted to this. If you go back probably to the private equity deep dive that we did, there's a few themes that popped out. One, to be moving down market in size. So this manager fits that box in that they're playing more in the lower middle market space. So smaller businesses where we think we can generate more return. Two, we have a pretty substantial underweight to Europe. And so we're in the process of building out that allocation. So that checks that box. And then three, we throughout time, or at least over the past 3 or 4 years, have been really focusing on looking at managers that have driven, excess return through value add. Their expertise is in financial services, technology, and in particular in the Nordic region, and have performed very well throughout time there. So that's kind of like the broader portfolio construction perspective there. But as it relates to the manager, it fills a niche within the portfolio that currently is underserved.
Thank you, Steve. That's just what I wanted to hear. Any more questions for Jeff on the delegated investment report? If not, I'll call, looks like executive session is next up on that. Mike, would you read that motion, please, for us?
Yes, sir. The motion would be to proceed into executive session to discuss investment matters and specific investments pursuant to SE Code sections 9-16-80 and 9-16-320 to discuss personnel matters pursuant to SE Code annotated section 30-4-70A and receive advice as needed from legal counsel pursuant to section 30-4-70A2.
May I have a motion to that effect, please?
So moved.
I have a motion. Can we have a second?
Second.
All in favor of proceeding into executive session, please signal by saying aye.
Aye.
Are there any opposed? We are in executive session. Folks, please bear with me. I will try to make this as seamless as possible. I think we've all got a different team set of instructions. So as we make this transition, it's 12:40 by my clock. We will get started no later than 12:45. I'm exiting this platform now and hope to speak with you again and no later than 12:45, folks. Okay?
Thank you.